Ladies and gentlemen, good day and welcome to the call with HDFC Bank, hosted by Credit Suisse. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Gupta from Credit Suisse. Thank you, and over to you, sir.
Good afternoon and good morning, everyone. Thank you for joining this session. We are very glad to have with us today from the HDFC Bank team, Parag Rao. Parag, as many of you know, has been heading the payments and the credit card business for the HDFC Bank for a very long time. He has built it up into the market-leading and dominant business in the country. Parag now additionally also heads the digital and technology part of the bank. Along with Parag, we are also glad to have Srini. Srini, as many of you know, is CFO of the bank, and he has been, of course, communicating with all of us a lot more frequently. And we are also joined with Ajit Shetty, who heads the IR function of the bank. In terms of format for the call, given that we rarely get opportunity to interact with Parag, there are quite a few issues we want to touch base with him on. So before we open up the call for Q&A from the audience, what I propose to do is raise 3-4 topics with Parag, get his some of his initial comments, and then maybe for the second half of the call, I'll open it up for the Q&A. So with that, I would like to once again welcome Parag and Srini on the call. Parag, thanks for your time today. And maybe to start off with, if I can talk about the payments business of the bank. From the early days of the bank's history, I've always seen that the bank recognized payment as one of the most integral part of its franchise. In fact, initially, even before the consumer business, it was dominance in certain payment and cash management products that really led to the franchise creation for the bank. Lately, we have been feeling that the payment business is becoming a lot more competitive. The competition is emanating not just from the banking sector players, but a lot of competition emanating from players outside the banking domain. So in this environment, how do you kind of think of the payments business? How much of a revenue opportunity it continues to present, and do you see a potential for market share loss?
Okay. Thank you everyone. Thank you, Ashish, for the warm welcome, and good afternoon, everyone. Well, I'll try to take your question in 2 parts. You're right, Ashish, in mentioning that yes, payments has always been important, strategically important for the bank, even before we actually launched the cards business almost 19-20 years back. Okay, the simple reason is that in financial services there are, as you know, there are 2 categories of products. One is there are transactional and engagement products. Okay, that's number one, and the other side you have one-time products which are almost like annuity revenue products, etc. You have the assets, you have third-party products, etc., etc. And of course, you have savings accounts. Okay. Payments, we right from day one, I think we've been very clear. Engagement products in the financial space build a lot of frequency of habit of engagement with the bank. Okay. And in the process, obviously, give you revenue and an opportunity for the customer to feel and see the bank. Okay. And then you build your other larger retail strategy around that habit of getting the customer, giving them a reason to sort of come back to you again and again and again. Okay, you'd see that in many of the transaction products which go beyond even credit card, whether it's CMAT, whether it's various other properties. So you've actually hit it on the head. Transactional products and card products and payment products become the entry point for many customers to the bank relationship from an engagement point of view. Okay, and we build out on that. And that's how we build up our strategy. Okay, so yes, very clearly from day one, I think we built up our payment franchise with that philosophy in mind. Okay. And of course, we've also had the other leg of our strategy has been focusing on existing bank customers. So as you know, even today also 75 to 80% of our customer base, okay, and of course of our incremental acquisition focuses on a customer who already has at least one existing relationship with the bank, and then getting in through a payment, especially a credit card or could be a debit card, or nowadays the newer forms. Okay, you build up his engagement and frequency in the relationship and keep on building up and deepening his product relationship with the bank. So to that extent, I think so that's how it is. Again, because of the sheer large distribution and spread and scale of our large retail business or consumer business, we've built the card business on top of that, and with a single-minded focus of driving scale. As we said, a lot of economies of scale, a lot of benefits have accrued with this 75-80% in-house internal bank customer strategy, and we built it into this kind of a dominant business. To answer your second part of the question, over the last 3, 4, 5 years, especially from the advent of the prepaid wallets, and then subsequently after that, variations of that, and then subsequently after that, new kid on the block, which is UPI, introduced by NPCI. These are new form factors which have emerged in the Indian marketplace, and I think these have grown rapidly. Okay, our take on an HDFC Bank's take on these two form factors is that whilst we're in that space, okay, but let me step backwards and look at it from an industry perspective. I think both these form factors did a fantastic job in expanding the base of customers who actually have now got used to electronic means of payments. I think that was the first, I think, immediate objective of expanding the base. There was always credit cards. People always say that it's a very small base. I remember even 5-6 years back, the base in credit cards was about 35 odd million, which itself was very small. Debit cards, significant number of debit cards in the hands of customers, but number of active customers very low. Okay, I think so wallets and then subsequently UPI post that, I think, bridged a lot of gap in bringing on a huge new set of customers onto electronics. Again, yes, of course, most of these transactions, are almost 80-90% of these transactions are the low ticket size transactions. Average ticket size is 150, 200, in some cases even lower. Okay, but I think they've done a fantastic job of upgrading a lot of these people. Okay, collateral benefits of this electronification and people using these transactions, I think people have now understood how they can make transactions on their mobile, on the net. Okay, a lot of them have started sort of migrating upwards to much more advanced forms of payments. They've started now using net banking. They've started using their debit cards, and of course, they've started taking loans and become aware of credit scores and things like that, and aspiring to take credit cards. So net in all, I think the market is expanded. I think that's very good. Okay, our strategy in terms of addressing this new incremental way is multiple fold. One is, if you take one aspect, let's say we are a very large acquirer, as you're aware. On the acceptance side, we have close to 42-43% of the physical merchant space and 50% of the electronic merchant acceptance space by volume. Okay, I'm talking about by the volumes or the spends which flow through that network. We are a full suite acquirer, so therefore our solution when we go to merchants includes not just card acceptance rails, but also include the acceptance rails for many of their other newer forms of payment, which is QR codes, wallets, UPI, etc., so that when a merchant wants to deal and start accepting electronic payments, All he needs to do is come to HDFC Bank and sort of get the full suite of all acceptance methods which his customer wants to use or which he wants to accept, and he's up and running. In addition to payments, we also provide him the full suite of liability products, savings products, current accounts, etc., etc., and we also give him the full suite of asset products. All these three are very important from his business point of view. Okay, and so therefore we become a full suite service provider, financial services provider, payments, liability, banking, assets, which are fundamental to his business. In addition, of course, there are other value-added services like third-party or even wealth management services, which we also offer him. So in that sense, we have become a full suite financial services provider. Okay, I pause it here, but I'll come back to this, the point I just now made about being a full services financial services provider. So that was one aspect of the thing. Similarly, on the issuing side, wherein we're issuing instruments beyond credit cards and debit cards, we also focus a lot on our UPI handles and enrolling a lot of most of all our customers onto UPI handles. Okay, we started out with our own mobile wallet, PayZapp and SmartBuy. I think, admittedly, I think we've done reasonably well. I would not say outstandingly well. So we realized that last year, and we are now on the path of revamping PayZapp and SmartBuy, our mobile properties and our marketplace properties. And in another couple of months, you will see the newer versions of these two properties completely revamped, differential UI, UX, new stacks, very focused on a superlative customer experience on the mobile for shopping, with the idea to say that how can we become the best payment app in the country, which includes all payment forms and of course the whole suite of the strengths which the customer banks acceptance business and issuing brings to the table. Okay, and we have very aggressive plans on that front. UPI payments inside PayZapp will be one of the major drivers of growth in that space. So once again, so that's another part of our thing. We are the merchant acceptance merchant acquirer for all the top merchants in the industry, online and offline, including the PSP for the acquiring bank for 2 or 3 very large fintech players in the UPI space. So we're very cognizant of the fact that UPI is a very important growth area for small ticket size transactions in India, and we continue partnering with all the merchants in that space by being the preferred acquirer for that space. The last leg of the way we sort of address this whole growth area is that without really taking names, we are currently in the process of finalizing product launches, platform launches with a couple of strategic partners in the space. These partners cut across the e-tailing segment, they cut across the fintech segment, they cut across the aggregator segment. The whole reason for these strategic relationships is that both the parties bring their relevant strengths to the table. HDFC Bank with its strengths, and say maybe the partner which brings its strength of let's say the strength could be of having a great capability in building digital platforms, or it could have a strength of being a very strong digital marketeer, etc., etc. The idea is to pick up strategic customer segments which are emerging, offer them jointly, co-branded or otherwise, joint digital programs to this set of customers, and as I said, jointly grow the marketplace. So that's the other leg, or that's the last leg in terms of our strategy to sort of address many of the newer payment forms going on. Having said all of this, I think our conventional credit card, debit card business will continue growing. We continue to rapidly and aggressively grow on the retail franchise side, our liability side, riding on that, and therefore our strategy will continue of focusing on our internal customers, roughly 75-25 basis, internal versus external, and therefore we'll continue growing our existing credit card, debit card, prepaid card businesses and our merchant acceptance businesses. So our strategy will be to continue to dominate in the conventional payment space and use partnerships and a large customer base to also attempt to become, although it may take a little bit of time to become dominant even in the newer payment kind of forms. So we've got a full holistic strategy to address this approach. Ashish, I leave it here, and maybe you can branch out to any specific questions you want.
Yeah, sure. So my one kind of follow-up from there is, particularly as you mentioned that you have done a lot of work on UPI, and if we see HDFC Bank share on the UPI transaction is fairly high, but if we see how the consumers are accessing that, they are channelizing it through third-party apps. Right?
Correct.
And so one of, I think globally is a concern, and it is not just specific to HDFC Bank, but overall concern is that over time, does the banking sector itself get disintermediated in some sense because of this more digitally savvy products becoming available? And you also mentioned that you have done several partnerships, and we are aware of a few partnerships, particularly on POS side, that have been very successful. But the question there is that what does that mean in terms of future opportunity loss? Because per se, none of these apps being solely a channel for UPI is going to be a revenue opportunity for them. So clearly, they will try to monetize the customer's data, and most probably through more financial services product. So is there some potential opportunity loss for the bank in the future?
Okay, let me answer that in a different way. Any consumer, whether it's an entry-level consumer, a mid-level consumer, a high-end consumer, or a very heavy traffic consumer, or just a fledgling in the payment space, okay, has a range of transactions in his entire basket. Okay, all of us look at our own patterns. Okay, we all have a mix of small-ticket transactions, medium-ticket transactions, daily transactions, infrequent transactions, and high-value transactions. Okay, and all of us, including consumers across the globe, spread out our risk and our transactions across multiple forms. Okay, that is natural consumer behavior. I have not seen that behavior changing over the last 20-25 years, and I've seen enough of sort of evidence across most consumer forms. If at all anything, people adopt newer ways and means and forms which are convenient, but they do not discard their existing forms. Okay, simply put, what I mean to say is all consumers nowadays use a basket of different instruments depending on the type of transaction. There is the high-value transaction, high-value, high-frequency, high-value, low-frequency transactions which need to be converted into equated monthly installments, transactions which need to be on a standing instruction, transactions which are fill it, shut it, forget it type products, transactions, etc., and the whole gamut across their online, offline, mobile, etc., etc. Okay, like I said in the previous question, that I think wallets and UPI I think done a fantastic job in opening up the market for small value, small ticket, high frequency transactions, things which erstwhile people used cash for, and so therefore done a fantastic job of actually reducing cash and increasing electronification. And those transactions and the UPI transactions are actually tailor-made and best suited for it. Admittedly, I think all banks put together, if you see, I don't think have done a very good job in being the front-end consumer interaction app for initiation of a UPI transactions. There, admittedly, The 2-3 fintechs, which we all know about, actually have done a fantastic job in creating a wonderful customer experience and ensuring that it is truly single click. Having said this, the entire UPI ecosystem, as you know, is devoid of any revenues, and so therefore people who will base their businesses purely on UPI will always have a challenge, a singular challenge of building not just a viable economic model, but also how do you defray the cost of accepting customers who are going to use these for thousands and thousands of transactions and still try to sort of upgrade them. So our experience, getting back to your original question, has been that while customers may onboard themselves with simple, easy transactions with lovely consumer interfaces, the bulk of their financial transactions as they mature upwards, will continue to be with mature financial services players where not just stability and consistency, but also values like trust, brand name, availability across multiple channels, across multiple form factors, etc., become extremely important. This is a learning I think we all see. It's happening across the globe. And so we're very clear. Accordingly, our strategy therefore is saying we're not really sort of building our strategy to take some of the newer players head on. We are very clear. Like I said, if we are we want to be the full service financial services provider to either a consumer or a customer. The consumer are people like you and me, individuals. The customer could be a merchant. The customer could be an institution. It could be a corporate. Sir. Our USP reason stands to say that we stick to our knitting. We stick to our competencies. We are in the banking space. We provide you liability products. We provide you investment products, transaction products, payment products, and asset lending products. And that's our core competency. And these are, and all of these forms put together, either as a combination or standalone, are fundamentally what any consumer or customer will require in this space. We will provide him the full suite of products, whether it's entry-level products, simple products, and we'll also provide him mature products, complex products, which fulfill his needs. So our strategy, if not anything else, becomes even more stronger. Our task, so that I'm not completely sort of pushing away the so-called, if you may call, challenge or the opportunities which the fintech producer, I think. So banks and people like us also have to very clearly learn, and we're doing all of that, and we're doing all of that. Maybe I'll take that in a separate question. Is that building digital products and platforms which are seamless, which are infinitely scalable, which have a wonderful UI UX, which are practically zero touch, which ensure that processing of transactions at the back end become extremely seamless and safe, and which therefore give the ability for customers to not even touch the bank physically, but access products and services in any remote manner in the channel of his choice. I think that's an area which all financial institutions and banks like us need to do. We have a significant amount of our bank's focus, investments, people focused on this part of the bank, of building our bank, and that actually comes under the other hat which I wear of being the head of technology and digital, and I'll talk about that slightly differently. But that's enough, and that's the area we do agree where I think banks need to improve on. We've done quite a lot of work, but a lot of work is still WIP. This, if you may call so, transformation of a conventional bank to become a very lean, a very agile, very 24/7 digital, customer-centric, paperless, contactless type of sort of experience to its customer, I think is a journey. And we're well on that path in that journey. We're also very clear that we will leverage the strengths of the existing bank, which have helped us become of this stature over the past 25 years. And we'll add on this newer sort of set of opportunities, which I think the digital age has brought upon us. And together, I think, like I said, we're preparing ourselves for the future. So I'll pause here, Ashish, and then take it on from there.
Yeah. No, thanks so much for those responses. Maybe to move to one of the other hats you wear is running the card business, right? So, there are a couple of questions here. One is that you have been a dominant player in the card business with almost more than a third of the market, but recently we have seen some market share loss as competition has increased. How do you see that space? The second question here is that, as you mentioned earlier, that credit cards probably cater to a small segment of the market today. We have seen, again, through some fintechs now, at the lower ticket, we have new credit products of buy now, pay later becoming more popular. So any plans of addressing that market? The third kind of relates to the profitability levers on your card business, right? So we have all been very impressed that through the cycles, because of your focus 75% on liability customers, the delinquency experience has been much superior to the industry, and by all indication that seems to have held true even last year through COVID. But the other levers in terms of conversion to EMIs, conversion to term loans, seems to be again much higher for your business. So how do you look to manage that piece? Or how do you kind of plan for what's the share of revolvers versus conversion to term loans? And what have been the factors that have led to you having a much stronger conversion to term loans?
No, well, Ashish, you asked actually 4 or 5 questions in one question. Okay, so let me sort of try to unravel some of the pieces. Okay, you must have seen, to answer your first question about market share, I think all of you would have seen the published data wherein our banks, I think, number of cards market share as reported by RBI would have dropped over the last 5, 6, 7 months. I think the reasons for that are very clear. We are all aware that there is a current embargo going on us issuing credit cards. Okay, and that's the result of why our numbers are dropping. If you notice, our spend market share hasn't dropped. We've in fact sort of gained it gained a couple of half percentage points, couple of basis points over the last couple of months. Okay, and that gain in value market share, and by the way, as you know, profitability metrics, size, book size, and various other financial metrics happen when throughputs increase, spends increase, and spend market share increase. So we've always, and let me in brief sort of address some of that thing. While so this embargo, I think, is a temporal thing. We already have our plans ready as to once this sort of whenever it sort of opens up, we're going to get back to the market with even more increased vigor and rigor. Like I said, 75% of our credit card sourcing will happen on the bank's base. We've been sourcing aggressively liability customers over the last 6, 7 months, and so we have a full set of customers, pre-approved, pre-scrubbed, all of that ready already. As soon as things open up, we're going to get back to the marketplace with the bank, and so some of those shifts which you saw in the incremental market share will soon get sort of completely corrected. Okay, our focus on portfolio, which is building a very strong, engaged set of customers on our card base, has always been there from day one, which is why we enjoy a significant volume market share, the spend market share, and also why our card base is probably one of the most active card bases. That strategy continued during the entire pandemic and lockdown, okay, and even so more so in the last 6 to 7 months. And like I said, there is no question, if not anything else, we'll further our efforts on building the portfolio. So soon you will see both the metrics increasing significantly in terms of market share. So I think that sort of addresses the first part of the question. The second part of the question was about, you talked about newer forms of credit coming in, BNPL you mentioned. Let me tell you, traditional forms of funding or asset lending on the card base, there were two traditional forms. One was what you call loans given within the card limit. That was one. Then the second one was what we know as conventional customers, we know them as EMI, which means you could purchase a card in a merchant and convert it into an EMI at the point of purchase. Okay, these are the two conventional forms of payment. They continue. Okay, the third form is BNPL, and I'll talk about BNPL slightly later. I think, admittedly, the easy EMI, as you call the HDFC Bank product, which is funding at the point of purchase at the merchant place, online or offline, is an EMI product. We call it easy EMI. Even as an industry, if you make also, I think the penetration of such spends into the entire total pool of credit card spend itself is very low. We were also the pioneers, HDFC Bank, in introducing the easy EMI on debit cards. Too, and we've seen fantastic success there. So even if I put both the bases put together, our credit and debit card base, I think the penetration of easy EMI into the spends happening on both credit and debit, I think is pretty low. It's in single digit figures, and at an industry level, I think it's even far more lower. So there is a significant upside in building this form of financing products at the edge. It's convenient, it's easy. You just walk into a store, swipe the card, and you can walk away with the product. Similarly, you can do that online. Okay, and typically most customers use card EMI products for simple convenience products, but ticket sizes anywhere ranging between 15,000-20,000 and going up to even lakhs also. Okay, the penetration there is very low. We as a bank are very keen that we build up this easy EMI franchisee in the way, and we've taken a lot of steps in this direction. On the acceptance side, which is tying up of merchants, we ride on our merchant acceptance base. All the merchants who offer EMI typically would be our merchants where we have a POS machine, either through us or through our partnership with Pine Labs. Okay, so we have a dual relationship with that merchant, and thereby we drive a lot of synergies of EMI in those space, and a lot of merchant level activity which we do to ensure that EMI facility is available in every POS machine, and merchants are incentivized to sort of actually drive customers towards merchant. Admittedly, I think the penetration of EMI into categories such as electronics, white goods, TVs, mobiles, etc. is pretty high. There I would reckon that the penetration of these products are close to about 30-40%. Assuming 100 rupees is spent in that category, 30-40 would happen through a financing mode, especially on cards. Most of the other categories is, like I said, in single digits. So there's an activity and a lot of work which we are doing of enabling and popularizing the easy EMI, the card EMI franchise on many other categories like shopping, apparel, luxury goods, cosmetic surgeries, etc. There are multiple new lifestyle segments, as you call it. Okay, and that is a very important part of our payment strategy of driving a lot of funding at the point of purchase. Here we work very closely with merchant partners across the length and breadth of India in the physical space, and also a lot of our online partners to drive the whole concept of card EMI. BNPL, coming to BNPL. BNPL is in the way it is today, typically is about financing very small ticket purchases. We've seen average ticket sizes of funding ranging anywhere between 1,000, 2,000. I've seen some cases even lower than 1,000, but average would be 2,500. Now so therefore BNPL is actually, the way we see it, is not really an asset product, because the kind of book size and book building you can build up on those small ticket sizes with very small tenures, the tenures would be ranging from 30 days, 45 days to even maximum 3 to 4 months. On an average, I'm talking at a book size level. Okay, so it's extremely unlikely that you can build a viable asset business on that case. BNPL, the role of BNPL, and we too have our product in this space, the role of BNPL as we see it is to act as a funnel for many customers to get onboarded onto this whole habit of purchasing electronically and buying them with easy credit, easy installments. There are multiple forms of BNPL available in the marketplace, but it's a transactional product, like I said, and therefore we see BNPL as a tool for customer acquisition through the route of lending. And we've got our product in place. We've run pilots with a couple of merchants. We've seen good success, and therefore, and BNPL will be a thrust area for us. We're also working with partners, fintech partners and other aggregator partners in this space to actually sort of address different segments in the small ticket size segment so that we can increase the funnel of customers in this. So put together between card EMI, which is an established large business for us, and which we are driving through our merchant acceptance space and a lot of drive as a percentage of total spend, and BNPL, which for us will be a customer acquisition tool to onboard customers on through the route of asset purchase. We are very clear that this space of financing at the point of purchase and thereby acting as one more layer of engagement with customers is an integral part of our growth strategy, and thereby will make us intrinsically even more stronger in this space.
Thanks, Parag.
I hope I've answered all your questions.
Yes. No, you have. So you have touched all of. And in fact, before we open up, maybe if you could talk about the technology upgrade plans the bank has, clearly that has been an issue of contention over the last few months or probably a year. So the bank has fallen short on some of the deliverables, even on the payment side. When we look at it, some of the success rates on UPI for HDFC Bank transaction going through is lower. We of course are all aware of some of the challenges in terms of downtimes that have happened, and there have been varied reasons, whether it was the disaster recovery center or otherwise. Recently we have had issues with the net banking and the mobile banking apps, and of course there's this whole issue of the RBI embargo. So what are firstly the key shortcomings that were there that led to this? Was it some sort of underinvestment, or was it the legacy platforms that were being used? And now what is the path to recovery?
Okay. So thanks, Ashish. For the tone of question, and I'm joking, I'm pulling your leg, I'm telling you in advance, it sounded like as if everything is bad with the infrastructure in the bank. Okay. But no, let me sort of address this in a different way. Yes, you've seen over the last year or so a lot of media coverage about some of the things, whether they were outages or slowdowns, etc., etc. Let me sort of try to at least attempt to set the record straight. I think outages and things, these things happen in a large infrastructure type of way, especially for large banks. We are not the only ones who sort of face outages. I think outages happen across every institution, big or small, not just in India and abroad. I do not want to dwell upon any of the statistics. Okay, and so I guess maybe our bank receives a little more attention than probably, especially when such incidences happen. Having said this, let me also say now I'm putting on my technology and digital hat. Let me put it this way. I think the infrastructure and the capabilities that we build in the bank, which helped us become our size and stature and etc. in the last 25 years, I think have held us in great stead. Over the last 5 to 6 years, with the advent of digital, with the advent of different business models coming in, I think one very important or two important vectors have been introduced in this whole rapid scale of growth. One is significant growth scale in many of the product categories, which I think, I just give you two examples, one example in banking and one in non-banking. I think a player like Uber completely overturned the whole concept of hiring a cab. Okay, and you can see the kind of demand being created, not just for cabs and rides, but also for vehicles. It's a secondary demand for vehicles which have been created, so much so that you have in many countries people have stopped actually buying cars because they rent. So that's an example of how an industry was created with significant amount of demand, and that significant amount of demand is in multiple X of what it was even before this disruption happened. In India, I think UPI is another example where small ticket transactions were all cash, but and I don't need to talk about the kind of scale of transactions which I think UPI is now talking about, which are already delivering, and we're talking about even more, where the transactions of UPI probably far exceed the transactions of many of the conventional payment forms already. So that was an additional vector which was brought in with this age of digital. The second, I think, vector which was brought in with the age of digital is that product life cycles, new products, new launches, changes, etc., basis customer need. I think the cycles change. Traditional industries, the traditional way, whether in banking or even in many other industries, typical product life cycles would range from 2 to 3 to 4 to 5 years. Okay, today you're now talking of product life cycles of months, if not weeks, and developmental cycles are even shorter. So these are two clear new criteria which came in. These two new vectors require a different form of IT infrastructure, digital infrastructure, if you may call so. Okay, and I think all of us have realized that. Okay, so some of the incidences which you see as a combination, I think, of rapid scale build up and maybe infrastructure not keeping up to the pace. Having said this, let me sort of talk about the positive side. We clearly understood that therefore there's a need to sort of change. I therefore get to an area which I talk about the transformation of the bank's IT, digital technology infrastructure. We're a very large bank, a very large successful bank. We've got 50, 60 million customers who are engaged with us across multiple products. They're riding on current core systems. Okay, and therefore one of the challenges faced with us is how do you therefore look at this transformation? So in a simple way, what are we doing? We're doing a two-pronged approach to transformation to be ready for the next 25 years. One is we're modernizing the existing bank. Okay, and we've created a vertical within our bank which we call the enterprise factory. The enterprise factory consists of existing technology and digital resources of the bank, and of course a new set of people who will be jointly looking at modernizing, digitizing the current infrastructure of the bank. I'm not going to get into too much of detail, but fundamentally we are really talking about looking at the bits and pieces of the existing infrastructure, removing them, modernizing them, building on top of it, and therefore modernizing the entire infrastructure. This is what the role of our enterprise factory is in. This work hasn't started yesterday or today. It's actually started quite some time back. Okay, but I must tell you that this is a journey. In large organizations, some of these things need to be done in a very calibrated and very careful manner because you're practically flying the plane and you're also sort of refurbishing the engine or adding on a third engine or a fourth engine. So one has to approach this in a very measured, calibrated way. And so this activity has been on and it's a constant journey. Having said this, there's a whole set of customers who now today want a completely digital native, cloud ready, mobile only, single touch or no touch, if you may call so, kind of experience with their principals for their products and services. Here we realize that maybe we need to sort of build a completely different type of digital infrastructure to cater to the needs of these kind of customers. So we built a second vertical as part of our transformation vertical, which we call the digital factory. The digital factory again is housed with a set of very competent resources focused on building the digital platforms, practices, processes, products, etc., and competencies for the bank. And we picked up areas of significant growth, if you may call so, which are going to help us on our journey, whether it's cloud engineering, whether it's looking at data networking, whether it's looking at the way you manage data, AI, ML, etc., various areas. And here we build the digital properties and the capabilities, whether it's DevSecOps, using the latest tools and techniques to sort of do a combination of technology and operations upfront, fail-safe building up infinite scalable capacity, nimbleness and agility in terms of our change around processes, etc. Put together, the enterprise factory and the digital factory will be the fulcrum of this transformation of HDFC Bank. And you will see over the next couple of months and of course into even next year, a significant amount of change which you see happening in the way not just customers interact with the existing part of the bank in terms of what they touch and feel, okay, but also significantly new platforms and products which we will be launching and introducing in this space, some of them on our own and some of them in partnership with some of the fintechs or some of the aggregators or some of the other newer players in the marketplace which we talked about, where we'll be bringing them latest digital products and platforms and programs. Put together, as I said, these two, the digital factory and the enterprise factory, will be driving this transformation for the bank and getting us future ready for the next 25 years.
Okay, thanks. And actually, I've taken a lot longer than what I planned to. But before we open up for Q&A, just quickly a comment on the status of the RBI embargo. Any update on that?
I don't know. Srini, would you like to sort of take that?
Yeah, this is the RBI thing you're talking about, Ashish?
Yes.
Yes. See, the timing is something that we don't control or we don't have a visibility to. But from a process point of view, as we mentioned a month or two ago in some other context in the call, there was an audit by a third-party auditor, tech auditor, who has prepared the report and given to RBI. And RBI and our bank have been in engaged form discussing. There's something specific or new that we haven't discussed with RBI that is there right now. And it is under evaluation of RBI. So timing is not something that we have control or visibility. So we are waiting for RBI to revert to us on that.
Okay. Thanks a lot, Srini. So with that, let me just open it up for Q&A from the audience. Operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anand Bhavnani from White Oak. Please go ahead.
Thank you for the opportunity. I have 2 questions. So the first question about easy EMI. You mentioned that it's about single digit for all the value of transactions that happen, and it's an important area for us. Can you give us a sense of what kind of number we can reasonably achieve over, let's say, next 4 or 5 years through this product? I mean, from the current single digit to what could be the ballpark expectation? And if you can also comment a bit on how many debit cards are currently enabled for it, and how can that number evolve as well?
Okay. I'll answer your second question first. We have approximately 32, 33 million odd debit cards today as we speak, and this is a dynamic number. This keeps on getting incremented as we underwrite customers. We have more than 20 million customers who have an underwritten line. So more than 20 million debit card holders of HDFC Bank can actually use their debit card to avail of an easy EMI at a point of sale machine or online. Okay, so that's sort of point number 1. Okay, I mentioned that yes, the penetration of easy EMI into card spends, if you take debit and credit card spends put together, whether it's at the bank level or the industry level, if that is 100, Okay, then the penetration of easy EMI, and if you take debit, it gets even lower. It's in single digits. I can't speak too much about the efforts of the other banks, but we clearly see the opportunity to sort of take this penetration up. If it's X today, we do believe over the next 3 years, this can be clearly a 3 to 5x opportunity for growth. On financing at the point of purchase.
Okay. So if I understood you correctly, let's say if it is 6-7% today on debit card spend, it could be 3 to 5x, that means 18 to 30% for next 3-4 years. Is my understanding correct?
That's That's what we believe it can go up to financing.
Sure. And second, sir, in terms of our payments business, offline payment business, one of the key strengths we had was the POS terminal that we used to, we have historically been able to place across merchants. Now, increasingly, we see Pine has come up with a superior product and where they can map 15 banks PIN. Do you see that particular area as these POS machines kind of run to the end of life and new machines are installed, incrementally losing market share to Pine, which in turn can then feed into loss of market share in terms of payments, because once the terminal is different and not many banks are enabled, the amount of payments coming to us might be lower. So if you can give some color on how do you see this development? On one hand, Pine helps us on the EMI business. On the other hand, on the payments, we are kind of competing with them. So if you can comment a bit on it.
So Pine is very clearly in the EMI business. Okay, they use their terminal to act as a place where the software is downloaded, and Pine has the ability to connect with a large number of OEs at the back end, do the back end reconciliation, ensure that the offers are available at the point of sale, typically, and it's clearly in that business. Okay, they are not in the general merchant acceptance business. Okay, that's the reason why Pine is the leader in aggregating of EMI or aggregation of EMI offers, especially in the electronic space. We do understand that Pine is also now wanting to expand the EMI categories into many of the other categories which we're talking about. We were the first partner bank to partner with Pine close to almost 15-17 years back. Okay, we continue to partner with them, and a large portion of our expansion of this Easy EMI franchise, okay, is about partnering with Pine to go to many merchant categories and developing and enhancing the capability to offer EMI opportunities in those categories. Okay, so that's point number one. Point number two, I think one clearly has to note that ultimately offtake of EMI on cards is a function of the number of cards which an issuer has, okay, and the kind of activity or the active rate of those merchants and the kind of profile of customers which lie on this thing. So while Pine acts as an aggregator of offers and therefore acts as a very efficient means of being able to deploy offers at the point of sale for customers, ultimately the tactical and strategic tie-ups which brands do, whether it's an Apple or a Samsung or any other white goods manufacturer, or even a player like Byju's would like to offer EMI facility for customers availing of taking of his online courses, are typically with the banks and large issuers like us who have a large customer base, a large active base of customers who would like to consume. Okay, so it's a three-way sort of approach with this model actually works. HDFC Bank works with Pine together to sort of lay the foundation for acceptance of cards for an EMI transaction at the point of sale, and the bank works very closely with the brands or the partners. And brands are not necessarily the national brands or the global brands. We also work because by virtue of a very large merchant acceptance footprint, we work with a lot of local and regional brands also to offer EMI for their set of customers at that point in that particular geography. So, for example, just to give you an example, we could work in a small town with a local, let's say, furniture manufacturer who enjoys a significant footfall in that particular town, and we are his merchant acquirer. So we work with him to ensure that a lot of our customers actually get great offers on that particular furniture manufacturer in that particular town, so that they can avail of goods and services on EMI. Okay, so that's the second leg of the partnership. So we work with a host of brands, global, national, regional, and local brands, to expand this whole franchise. I hope that answers your question about how we're approaching the EMI market in partnership with Pine.
Sure. Just one follow-up question. When it comes to subvention from OEM, do you negotiate it directly, or does Pine negotiate the subvention that you should get on the spends on your credit and debit card?
Typically it's done by Pine, because Pine would sort of has laid the infrastructure down to administer many of these schemes through the POS machine on the network itself. Typically it would be done by that, but in some cases it's done directly by the brands also.
Great. Thank you, sir.
Thank
So,
you.
Parag, there's a question from Antrix from ICICI Prudential. Unfortunately, he's not able to log in his question. So it's
Okay.
on the card business. There are three questions. First is, what is the penetration of credit cards in the liability customer base? So what is the headroom to increase it further? Second is, through COVID, all segments have seen higher credit costs. What's the magnitude of increase for the credit card business? And third is, how different are the delinquency experience or credit cost experience in cards versus personal loans?
Okay. Okay. So we've got what, 15 million plus cards. Okay. And you know our liability base. So very clearly there is more headroom to grow. Okay. The reason why, and one may ask, why haven't we penetrated our liability base in its totality or near totality? This answer is very simple. We apply, even on our own internal base, we apply as stringent credit underwriting standards and measures as much as we would do otherwise also. And so we are very clear. So whilst the liability franchise of ours is an important base on which we would sort of want to sort of penetrate credit cards, we will not dilute our standards, and hence you see the kind of penetration we've got. Having said this, I think our liability franchise continues to grow on a day-to-day basis, especially the retail franchise base. Okay, and so therefore the headroom to continue growing on our internal base exists and will continue to exist, which is the reason why I said our strategy of doing a 75-25, which is 75 internal customer and 25 external customer, will continue in the foreseeable future. And like I said, we do not dilute our credit norms, even though I mean we dilute our norms to the extent that we have more data on the customer. But do we dilute fundamental credit norms? The answer is no. So we're as strict on our credit underwriting methods, whether it be an internal customer or an external customer. The second part about comparison about delinquencies during COVID times between cards and PL, maybe I'd request, I think, Srini to handle that at a larger level, if you could do so.
Yeah.
Srini?
Yeah, we can talk. See, we have not put out the data, which in this call I cannot give new data in terms of individual product delinquency, but generally we have spoken about that as it relates to unsecured products, which is predominantly PL and cards, or our customer base, and from a delinquency point of view, which we pointed out to the Bureau, when the Bureau delinquency is 1, our product delinquencies are anywhere from 0.4 to 0.7. That's the kind of bid and ask in terms of the range, if you need to know, right? That's where it is from a relative sense. between those products.
Okay. No, and between the two, will cards be higher than personal loans? I guess given the yields, that should be the logical conclusion.
Not necessary, right? It depends on vintages and depends on whether liability relationship, third-party relationship. You have to look at it from a different. Looking at it in aggregate is not something that makes complete sense. But you have to look at it. Do you have a relationship, liability relationship, PL liability relationship cards, third-party sourcing channels? So many other criteria that come into play. But then at an aggregate level, which we have talked about as an unsecured product, that's a kind of a relative sense in terms of what we have talked about in the past.
Okay. Thanks. And Srini, as we have you online, so one of the questions that Parag earlier answered about the technology transformation. So given that the tech spends are going to meaningfully go up, how do you see it in light of your targets on cost-income ratio, cost-to-asset ratio? Do you think in the near term the downward journey will stall or maybe even reverse before resuming?
Yeah. We have always said that during this COVID kind of a time period that we have had last 12 months or something, that the cost to income came down, but that cost to income will revert towards, call it 2019-20 type of levels to 38, 39, or even 40 it can touch depending on the timing of spend in the short run. But then the medium term to long term goal is to bring the cost to income to mid 30s. So that is a clear kind of goal and actions that we have in place. And some of these technology type of initiatives Parag referred to are exactly in that direction, where zero touch, zero paper, right? That kind of a theme and approach to various things, both let it be driven through the enterprise structure or driven through the digital factory. The goal there is to get to, where possible, zero touch or near zero touch type of digitization. Yes, in the medium to long term, we will drive it down. That is the trajectory you should expect. But then in the short run, you should expect the trajectory to go up, which we have always said once the acquisition momentum picks up, once we start to recruit people, make investments, we start to open branches, you will see that it goes up before it starts to come down.
Okay. And if I can go back to Parag. Parag, as this new tech upgrade plan is building up, you mentioned how the customer traffic had gone up with UPI. I guess another factor would have been the bank's enhanced liability customer acquisition strategy over the past few months. So as now you are building up the platform, so what sort of capacity are you looking at? Are you building it up for potentially up to 100 million clients over 2 years, 3 years? So are there any such capacity benchmarks?
Okay. So we are, let me put it. So when it comes to UPI, aside of our bank's customer base, and you're right in terms of our customer acquisition on liability side, each one sort of has a handle and therefore uses UPI. So there's significant growth of customer UPI transactions happening there. That's for our bank customers. We are also a large, like I said, we're a very, very large acquirer with significant dominant market share, especially in card acceptance. In UPI, we're slightly lower in terms of our market share, but there too we've got rapid plans in growth. So we are the UPI acquirer for many of the merchants. We're also clearly PSP and acquirer for one of the large fintechs, which has almost a 40-45% UPI market share of acceptance of things. So we drive a lot of UPI transactions on our through the merchant acquire, so through our UPI switch and acceptance thing. There we've already enhanced our capacities keeping into account the kind of growth which we're really talking about. Difficult for me to talk about whether in terms of multiple X, but very clearly, like I said, we've already made we've done one level of capacity enhancement. We've also done one level of, if you may call so, system and network optimization to ensure that the transaction flows are that much more efficient. Okay, given the kind of growth in UPI, this is a constant exercise, but we are very clear that UPI is a very strong transaction driver. It's a very strong transaction driver for customers in terms of engagement, and we will be always ahead of the curve in terms of our investments, in terms of capacity and network optimization. It's an important space, and notwithstanding the fact that while revenues today are very low, but it's an important strategic area of growth, especially in payments. And like I said, we will continue to be ahead of the race in terms of our investments to keep on enhancing either the efficiency and the capacity, and also in partnering with people who sort of bring a lot of UPI skills to the table.
Okay, great. I think we have already run past our hour, but let me check with the operator if there are any last questions in the queue. Steve, is there anything in the queue?
So as of now, no questions in the queue, sir.
Okay, so I think then with that, I would like to again thank Srini and Parag for their valuable time, and especially Parag for being very frank with his responses. So thanks for your time, gentlemen.
Thank you.
Today.
Thank you, Ashish.
Thank you.
Thank you very much.
Thank you all. Yeah.
Thank you.
Bye-bye.
Bye.
Thank you.
Bye.
Ladies and gentlemen, on behalf of Credit Suisse, that concludes this conference. We thank you all for joining us, and you may now disconnect your line.